Welcome to Apartment Syndication Made Easy podcast, where we simplify the world of syndication. Join us as we unravel the complexities and provide you with valuable insights to help you invest smartly. Get ready to take your investments to the next level, one episode at a time. Here's your host, Mr. Vinny Smiles Chopra.
Tell us more. How did you get into limited partnership? What did you have to look into to vet the syndicators? I mean, there are good ones, there are bad ones. I mean,
Yeah,
there are risks involved, all that stuff, right?
exactly. Yeah. And the way I frame this is the mistake that I made was thinking I could do it all on my own. I don't need a mentor. I don't need a coach. I don't need training. Real estate's simple. I'm going to just go out there and do it myself. That was a big mistake. And so in 2015, that's where I started joining more of these networking the conference like you just put on, local groups, et cetera. And that's where I decided, okay, I threw in the towel and I said, okay, I really do need help, I guess. And I really do need to learn how to be more passive in this business. And the first time I had heard of a syndication or a real estate private placement, I was a bit skeptical because I was looking at a pro forma, the projected returns. And I'm saying, wait a second, you're saying I could maybe make the same that I'm making right now, but I'm doing all the work and I don't have to, it just seemed too good to be true. So I got started with one private placement, one operator. They were local to me at the time. I put in the minimum investment and I said, I'm just going to try this out. I was still a little skeptical. So I gave it about 6 months. And the distributions came through every month. The reporting came through. Anytime I had a question, I could just call and get an answer. And I thought, this really is, for me at least, the solution. This makes a lot of sense. And so to the point that a lot of other folks are in a similar boat. So yeah, there was a lot of lessons learned in those first couple of years of partnering with people. To your point, how do you know? How do you find the teams in the first place? How do you know if a deal is a good deal or a bad deal, et cetera? So the way I kind of look at this from a high level, I'm going to simplify it for everybody listening. There's 3 risk points, in my opinion, that you need to consider from a high level. There's the operator, the sponsor, the general partner, the team, let's just call it the team. 2 is the market. What market are you buying in and why? And what are, the stats and facts to the market? And then 3 is the deal itself. And what I see a lot of LPs like myself, a big mistake, I think, myself included, that I made was I was only looking at the deal in the beginning. I was just saying, show me the deal, show me the numbers. What am I going to make? And I wasn't thinking about how important the team is and can they actually execute the business plan?
Yes.
Is this actually realistic, or are they just being super aggressive and saying, we're going to quadruple your money? So you really have to be diligent, and it takes some education. So glad that, you do these conferences, you write these books, you offer these programs, and so many others do as well, because that is key. You have to have a foundational education in this space, especially if you're going to be active. But even being passive, you have to understand terminology and what are cap rates all about. What does break-even occupancy mean? Things to look out for in markets. So my journey's been going through those 3 and primarily vetting out teams and operators to work with, making sure we're in a growing, expanding, diversified market. People and businesses are moving there. And of course, that you're doing a good deal. You're not overpaying for a deal, and that, the underlying, metrics on the deal make logical sense, and that they're being conservative on the underwriting.
The assumptions. That's right. I'm so glad you used the word conservative, because you could really flip some numbers around very
Yes.
quickly in the Excel worksheets, and the numbers can go from 10% return to 20% return. And you won't even know where it was changed and where,
Yes.
But the key thing is what you just also said, it's the team, the top sponsor, the GPs. How many GPs are there? How many cooks in the kitchen, I call it,
Yeah.
If there are too many cooks, too many chefs, then something is going to burn. The recipe.
Yep. That's a great analogy. That's exactly it.
And also, I'm so glad you said the operation part of it, because it's not what we buy. That's what I've done. I've done 34 syndications now so far,
Yep.
and I've been the GP on every single one. I think I only needed two other times some other co-GPs, two or three, let's say, in the big ones, 52 million, 35 million. But
Yeah.
before that, it was all the one company. But the key thing is, it's when we get the keys from the seller of the property, then the job begins, isn't it?
100%. Exactly. Yep.
So tell us more then, how should a new somebody, let's say a doctor, right? He wants to put 200, 300, 400. So they should look into those three things, but how are they go about it? I mean,
Yeah. Good question. So, there's two kind of offerings that are probably most common in the industry. You have these 506C offerings that can be generally advertised, solicited, so they're more visible to the world. You might even see a Facebook ad or something pop up here and there. Then you have 506B, B as in boy, where you may find the company that says, we're a multifamily investment firm, but they're not going to be showing you any deals, through their website or what have you. And so it's a little bit harder to get to know what they're really about and what they're doing. So ultimately, in my opinion, this is a relationship business, like many different businesses, right? So you have to network. That's the power of these real estate groups and these ecosystems and these educational things that you can get into, is meeting other people and asking around. My perception in the beginning was there's not that many of these deals that exist because I don't see them anywhere. But now it's the opposite. It's like, wow, everybody's doing a deal. How do I pick? And that took a few years to go about it. So I think the first step is the education piece, the book or the seminar or the training or the coach or the mentor, to understand the foundation. Number two is decide what your criteria is. Okay, what do you like, and how do you decide that? Well, what's your goal? What are you trying to do? People have different goals. John over here, as an example, wants 10,000 a month in passive income or cash flow. Sally over here wants a $3 million net worth so she can retire in 30 years. Well, those are way different. She might be using IRA funds. He may need the cash flow right now. So you have to decide new development, opportunistic, value add, etc. Monthly distributions, quarterly, no cash flow. There's so many different pieces here. Do you like the Sun Belt regions? Do you like the coastal markets? I mean, do you like mobile home parks? Do you like senior living? Do you like multifamily? There's a lot of things that you couldn't really decide on your own until you had the foundation built, till you had the education. So you want to form your own criteria based on your own goals, your own objectives. Then you're going to go seek out through word of mouth and through networking operators in the space that are doing what it is you're looking for. And that's kind of been my process. And so now I've narrowed it down to where I know my criteria quite well. And so when someone sends me a deal randomly and it doesn't match up at all, I can quickly just ignore or delete, because that's nothing I'm ever going to do. And I know why. And so otherwise you get caught up, or many people, I should say, myself included in the beginning, get caught up in analysis paralysis. It's like, do I do this deal or this deal or this deal or this? And all of a sudden you're looking at 50, you can't make a decision. It gets really complex. So I think those are some of the first steps for somebody, doctor, dentist, lawyer, attorney, business owner, et cetera, is, get the book, join the program, do the conference, whatever, write down your goals and criteria, seek out operators doing deals just like that.
Excellent. And again, you've got to really feel the trust, the transparency.
Yes.
It's a hard-earned money. I tell all my investors, we have about 400 investors now. Thankfully, I started with one, and now we have over 400. We could raise 6 to 10 million in few days, because they are always, looking for new things. But the key factor is, as a sponsor, and as a sponsor like me, but other people, the limited partners, entrepreneurs, or the investors should feel comfortable, and they should ask every question that they can come up with, to make sure that they are getting satisfactory answers, how quickly they are getting them. And are the people able to share the information with them, or hesitant about it, right? Or even talk to some of the present investors or some long-time investors who have dealt with the operators for some time,
Yep.
because that can tell a whole picture, right? Yeah.
Exactly. And that's kind of the next phase on top of, that was a great transition point. Cause yeah, those are the next steps. You want to align yourself in philosophy. You want to get to know, like, trust these people. You want to get the word of mouth references. You want to look at track record. You want to look at experience. There's all of that kind of comes next after you know what you're looking at and how to look at that and why you're looking at that. Then it's taking it, to your point, to those next steps. And that weighted average, if I had to, make that up, I would say 50% of the importance is on the team, in my opinion, 25 on the market, 25 on the deal. And the reason I say that, if you're experienced and you've done it over and over and over, you probably know what markets to be in for your business model. You're probably not going to do a crappy deal if you've got a solid track record. So they kind of somewhat fall into place. You still obviously want to do your due diligence as an LP, but the key is the partnership, to your point.
I'm so glad you're saying that. Let's just dig into the PPM and the subscription agreement and operating agreement. Those are the three major, crisp and clear, and with the information packet, of course, and how much due diligence materials with these sponsors share with the investors so that they can have the comfortability in making sure that, what they are doing is correct. I really enjoy when my investors, they say, Vinny, oh, over here, they found, and could you explain something about this? It could be the IRR, or it could be the cap rate. It could be the exemption on the exit cap rate, those, and the taxes, how did you finalize, and the RUB system, why do you feel how you feel? So it's good to have those, questions answered, right?
Absolutely. Absolutely. Yeah. Communication is key. Absolutely. That's why I look for, part of my criteria. Everyone would be probably different here, but for me, I live on cash flow. And so I do a lot of stabilized investing and things like that. But I also look for, in my case, monthly distributions and monthly reporting, because I like to keep a closer pulse, and I like to know more frequently what's happening on the property level and things like that in the financials. But again, doesn't make it right for anybody listening. Just know your own criteria. That may not be as important to you, but I do know that the partners I work with, if I were to call them on a Thursday, either A, they're probably going to answer their phone. And if they don't, they're probably going to call me back same day. And if they just absolutely can't, they will call me back the next day. You know what I mean? I'm not going to be waiting for weeks on end and then, oh, I didn't realize you left me a voicemail. Things like that.
Totally. Let's go back into also, now we put the money with the sponsors, like anybody out there or us or you.
Sure.
Then what are the factors after that, the communication? Let's talk about that, So what do you feel should be the, how do you do it? Let's say that, or what can LPs expect? Let's just say.
I would say that first of all, it depends on the business plan that you're doing, so a new development, new construction, maybe a little less frequent on a few things, could be less frequent on reporting, could be less frequent on distributions, et cetera, versus say a stabilized value add with monthly distributions, So again, know your criteria, know what's important to you, but what can you expect? I would say the industry standard is quarterly communications. You might get some quarterly financials. Here's what's happened over the last few months. Here's what we, project forward, et cetera. I like to get a combination of things. I like to know occupancy, collections, some of kind of the high level metrics, what's happening in the market. Like, oh, FYI, a big company just moved into town. They're going to hire, 5,000 people. Well, that's great news, for that area and for that submarket. Also, unexpected events always come up. This is the real world. This is real estate. Things happen. So we just had a bad, Texas freeze happen. So I wanted to know, like, that week, what happened? Like I don't want to wait 4 months for an update and say, oh yeah, a few months ago, a whole bunch of pipes burst and
that, yeah.
yeah. And so we're no longer sending you any distributions. No, tell me right away, like as soon as reasonably possible, what's going on. Tornadoes happen, hurricanes happen, floods happen. Just keep your investors up to date. If you're on the active side, if you're a GP, and just let them know proactively about things that come up. Kitchen fires happen, all kinds of stuff, right? And yeah, to put it in a nutshell, it's fine to do quarterly reporting, but when the one-offs come up, make sure you address that, or else you're going to be getting a flood of emails, as you know, from investors. What happened? Tell me what's going on with the property.
Totally. No, I agree with you. Actually, my mentor many years back, 14, 15 years back, taught me, and I have kept that way. Once we close on the property, by the way, listening to me, anybody, we do 1 month later a Zoom meeting, and I go over the closing statement, because I want my investors to know what really happened. This is the documentation. This is where it came, the sales price. These are the costs that got into legal and this escrows. So I go over all that with my investors and show them the formation documents, the LLC, so that they can sleep nicely, that, the property is now, bought, right? I might introduce the staff, the team, our team, property management team. Then a month later, I like to do another seminar, Zoom meeting, to share with them the software, what we are using, because I want them to see that we are professionals, and what we have done in 1 month take over the signage or things, or maybe in the leasing office, some things we might have done. So this way we kind of get them going to a quarterly Zoom meeting. But the first 2-3 months are critical for giving them the transparency, and also making sure that they really like, and bring pictures to them, lots of pictures. I believe in that, because a lot of investors will never take the time to drive or fly to the property. So I ask my managers, always giving lots of pictures of CapEx and things like that. Then authentication, I think that's a big thing. I see some people like to put a lot of Excel worksheets, and I despise those Excel worksheets, because we need to give the snippet from the software with the date, the property at the bottom, the name of the software, as well as the date and when we ran it. If it could be the delinquency report or CapEx report, or P&L or rent roll, anything. Authentication is very, very important,
Absolutely. You're adding a lot of transparency, a lot of value, a lot of the education component. And again, back to who is your LP audience, your limited partners. They're folks that don't have enough time to be doing this stuff on their own. So they don't want to go spend their weekend going through detailed Excel sheets, trying to figure out, what does this term mean? And what does that line mean? And is this good or is this bad? And now I got to make a phone call to ask Vinny what this is. You're doing a great job proactively. And that's exactly it. And to your point, I'm a big fan too, of not only pictures too, but video as well. So, here's our new laundry room, here's whatever it is, here's the construction crew putting things together on the new development. Big fan of that too. So anything you can do to drive value that way is huge. Saves me a lot of time. I don't feel obligated that, boy, I ought to go book a trip out there and go walk this thing, because I don't know that they're really doing what they say they're doing. You don't want that uncertainty. You do want the authenticity and the transparency. Good stuff.
So true. Totally transparent, and they can ask for anything and everything.